Hey everyone, and welcome back to the Tesla Stock Podcast. The numbers are in, and Tesla has done it again, smashing expectations with a record-breaking 497,000 deliveries for the third quarter. But just as the bulls take their victory lap, the question on everyone's mind is, was this a sign of unstoppable strength or just a one-time sugar high before a major crash? With the stock now trading around the $429 mark, we need to unpack the blowout number, the boardroom battle it's fueling, and the company's real plan for what comes next. Let's start with the huge headline number. Tesla officially reported 497,099 global deliveries for the third quarter. This is a new all-time record for the company, and it absolutely crushed the Wall Street consensus estimate, which was hovering around the 440,000 mark. It's an undeniable beat, and on the surface, a massive win for the bulls. The company also deployed a record 12.5 gigawatt-hours of energy storage, showing strength in that part of a business as well. However, this record number comes with a giant asterisk that you could drive a Cybertruck through. It was almost certainly the result of a massive pull forward of demand here in the United States. As you know, the $7,500 federal EV tax credit officially expired at the end of September. This created a huge artificial incentive for U.S. buyers to rush and get their orders in before the deadline. As one CFRA analyst rightly pointed out, while the numbers were better than expected, we think it is important to highlight the data is backward-looking. This fantastic number is now in the rearview mirror. The entire debate for the stock has now shifted to one critical question. What do Q4 and 2026 look like in a world without this massive government incentive? And while the company celebrates this record quarter, a bitter civil war is brewing among its shareholders. This week, a powerful coalition of institutional investors and state government officials sent a public letter urging all shareholders to vote against Elon Musk's new up to $1 trillion compensation package at the shareholder meeting in November. The signatories include the state treasurers of Nevada, New Mexico, Connecticut, and Colorado, as well as the comptrollers of Maryland and New York City. Their letter is a scathing indictment of Tesla's board. They allege the board is made up of directors with deep personal and professional ties to CEO Musk, and that this has enabled a culture where the board consistently fails to challenge Mr. Musk, even when his actions are detrimental to the company's value. They point to his time-consuming roles at his other companies and his work in the Trump administration as proof that the board has failed to ensure he devotes his full attention to Tesla. This record delivery number actually complicates this fight. The board can now point to the 497,000 number as definitive proof that Musk's leadership is working and that he deserves to be massively incentivized. On the other hand, the dissenting investors can argue that this was a one-time, subsidy-driven beat, and that the underlying business is still struggling, making a $1 trillion package for a part-time CEO even more outrageous. This sets the stage for a major clash of narratives at the shareholder meeting next month. So if Q3 was a party fueled by a tax credit that's now gone, what's Tesla's plan for the hangover? Well, we just got our clearest look yet. The company's long-rumored, more affordable model has been spotted testing on a U.S. highway without any camouflage. And it confirms what many had feared. This is not the revolutionary ground-up $25,000 Model 2 that was promised for years and then abruptly canceled. Instead, it is a stripped-down, decontented version of the Model Y. The photos show a car that is missing the stylish front and rear light bars from the recent Juniper refresh. It also has new, simpler aerodynamic wheels. Based on software updates and earlier spy shots, we know the interior is also being downgraded with the beautiful glass roof, the rear passenger screen, and the ambient LED lighting all likely being removed. This is Tesla's plan to fill the $7,500 hole left by the expired tax credit. A potentially dodgy leak suggested a starting price of around $40,000. If that's true, after the current Model Y's price was effectively $37,500 with the tax credit, this new stripped-down model will actually feel like a price increase for many buyers. It's a pragmatic business move, but it's also a significant step down from the revolutionary promises of a truly affordable EV. So, to sum it all up, Tesla delivered a blowout, record-breaking third quarter, but the celebration is deeply muted by the reality that it was almost certainly a one-time event fueled by an expired U.S. tax credit. A powerful coalition of institutional investors is in open revolt against Elon Musk's new trillion-dollar pay package, setting the stage for a contentious shareholder meeting in November. And Tesla's answer to the coming demand cliff appears to be a stripped-down, compromised version of the Model Y. Not the revolutionary and truly affordable car that was once promised. This brings me to my question for you. Now that the Q3 numbers are in, are you more bullish or more bearish on Tesla for the next 6 months? Do you think the record quarter signals an underlying strength that will carry through the end of the year? Or are you worried about the demand cliff in Q4 and the fact that the new affordable car is really just a cheaper, less featured version of the Model Y? Let me know your thoughts in the comments below. As always, if you found this breakdown valuable, please hit that like button, subscribe to the Tesla Stock Podcast, and be sure to turn on notifications so you never miss an update. Thanks for listening, and we'll see you next time.